Welcome back to Faultline Finance Channel. On April 16th, 2026, the financial architecture of the world shifted again. Silver closed at $78.69. Gold reached a staggering $4,794.50. If you're watching this, you already know we are completely untethered from the monetary reality of the last 5 decades. But to understand where this goes next, specifically Dr. Stephen Leeb's target of $18,000 for gold, we have to look past the ticker tape. We are witnessing the structural death of the petrodollar system, an arrangement built on the 1973 agreement between Richard Nixon and Saudi Arabia. For half a century, global energy was settled in United States dollars, guaranteeing artificial demand for American debt. That era is definitively over. Today, we are breaking down Dr. Leeb's foundational framework. Why gold has quietly become America's most critical export, how China orchestrated a multi-year physical accumulation to front-run their own property collapse, and why silver, sitting at the intersection of a monetary crisis and an industrial supercycle, is the very last underpriced asset left on Earth. The institutional blind spot right now is assuming these price levels are a temporary anomaly rather than a permanent structural reset. When a global reserve currency loses its absolute monopoly, the transition is never slow or orderly. It happens in volatile, aggressive revaluations. Many investors are still attempting to value precious metals using outdated models. Those frameworks are entirely obsolete. We are entering an epoch where physical possession supersedes paper promises. Dr. Leeb argues that the sheer velocity of this transition will catch the majority of the Western financial establishment completely off guard. If you are holding conventional paper assets, you are essentially holding unsecured liabilities in a system that is actively deleveraging. Over the next minutes, we will map out exactly how this macroeconomic earthquake will unfold, step by step. We will examine the data, proving that physical supply deficits are colliding with unprecedented global demand, creating a truly perfect storm. To understand the $18,000 target, you must first completely understand the mechanics of global settlement and how profoundly they have fractured. Since 1973, the dollar's hegemony was uniquely underwritten by crude oil. You fundamentally needed United States dollars to buy energy, which forced every central bank on the planet to hold American Treasury bonds. But as geopolitical fractures widened over the last 3 years, a parallel settlement system officially emerged. We are no longer theorizing about macro de-dollarization. It is explicitly written in the international trade data. Look at the United States export metrics right now. In 4 of the last 5 months leading up to this exact moment, gold emerged as America's largest overall export. Let that reality sink in for a second. It is not technology, it is not agriculture, and it is certainly not manufactured goods. It is physical gold bullion leaving Western vaults. The rest of the world is aggressively demanding hard asset settlement for their trade imbalances because they no longer trust fiat paper. Simultaneously, we have to look deeply at China's overarching strategy. While Western media focused on the collapse of the Chinese property sector, the People's Bank of China was engaged in a deliberate wealth preservation strategy. By hoarding thousands of tons of physical gold, China successfully built an alternative monetary floor beneath their consumer wealth. They effectively absorbed the massive deflationary shockwaves of their real estate implosion by revaluing their domestic reserves. This brings us to the core of Dr. Leeb's thesis regarding geopolitical power. The nations controlling the physical commodities are now dictating the terms of global trade. The BRICS nations have systematically built a trading bloc that bypasses the SWIFT financial system entirely. Saudi Arabia's refusal to renew exclusive dollar settlement agreements was the final nail in the coffin. What we are seeing today is a massive, historic unwinding of dollar dominance. The Federal Reserve is forced to monetize its own sovereign debt. This means printing more currency to buy their own bonds, debasing the purchasing power. Gold is reclaiming its ancient role as the ultimate arbiter of global commerce. The petrodollar system is dead, and physical gold has stepped directly into the void to serve as the new bedrock of global monetary settlement. When an economist of Dr. Stephen Leeb's caliber publicly states a long-term target of $18,000 for a single ounce of gold, the initial reaction from traditional analysts is almost always disbelief. But this is not a speculative guess or clickbait. It is a target derived directly from the mathematics of global monetary transaction volumes. We are operating in a world that is completely drowning in fiat currency creation. If you take the total global M2 money supply today and attempt to back even a conservative fraction of it with physical above-ground gold, say 20% or 40%, which is what historical gold standard frameworks actually required, the math simply breaks at current valuations. At our current price of $4,794.50, gold is merely acknowledging the rampant inflation of the past decade. It is essentially pricing in the loss of purchasing power that has already occurred. However, it is not yet pricing in its brand new role as the primary global reserve asset required for cross-border trade. To facilitate massive global trade volumes without the infinite elasticity of the fiat dollar, the physical price of gold must completely revalue higher to provide sufficient systemic liquidity. $18,000 is not a fantasy number. It is the mathematical equilibrium required to balance the global ledger when fiat currencies lose their geopolitical utility and trust. Let us break down the exact formula Dr. Leeb uses. The current above-ground stock of gold is roughly 210,000 metric tons. Only a fraction of that is held by central banks as monetary reserves. Meanwhile, the total global debt has surpassed $315 trillion. The ratio of paper promises to physical reality has never been this historically stretched. In order for central banks to clear international trade deficits using gold instead of treasury bonds, the price of gold has to rise to a level where a single bar can settle billions of dollars in trade. If the price remains too low, physical gold would be drained from deficit nations overnight, causing immediate trade halts. By revaluing the asset to $18,000 an ounce, central banks create enough monetary bandwidth to allow trade to flow naturally, without instantly exhausting their physical reserves. Furthermore, we have to account for the velocity of institutional adoption. Up until this year, major pension funds, sovereign wealth funds, and massive institutional asset managers held an allocation to precious metals that hovered near 0.5%. As the structural death of the petrodollar becomes undeniable consensus, these institutions are being mathematically forced to increase their allocations to 3% or 5% simply to meet their fiduciary risk mandates. When trillions of dollars in institutional capital attempt to squeeze into a physical asset class that is already experiencing a sovereign supply drain, the price action becomes incredibly violent. Dr. Leeb argues that the journey from nearly $5,000 to $18,000 will happen much faster than the journey from $2,000 to $5,000. The compounding effect of panic buying by major institutions, combined with central banks refusing to sell their reserves at any price, creates a structural void of supply. The $18,000 target is simply what happens when unlimited fiat currency chases a strictly finite Tier 1 monetary asset in a fundamentally broken global debt system. While gold is successfully reclaiming its rightful throne as the sovereign settlement layer, silver presents the most profoundly asymmetric investment thesis of our entire lifetime. Let us be incredibly clear about the fundamental physics involved. Silver has zero industrial substitute. None. It is the single best conductor of heat and electricity known to modern science. As the entire global economy transitions aggressively toward advanced electrification, the demand metrics for silver are staggering and entirely unyielding. Every single solar panel rolling off an assembly line requires significant amounts of silver. Every electric vehicle requires substantially more silver than a traditional internal combustion engine. Advanced robotics, telecommunications infrastructure, artificial intelligence data centers, and advanced defense electronics simply cannot function without it. Yet, despite this explosive exponential demand, silver remains structurally trapped in a massive multi-year supply deficit. Mining grades have been steadily declining for over a decade. We are consuming millions of ounces more than we are pulling out of the ground, bleeding above-ground inventories entirely dry. But this massive industrial supercycle is only one engine driving the price. The second engine is silver's ancient and undeniable historical role as a primary monetary metal. Right now, closing at exactly $78.69, silver is profoundly mispriced relative to its sister metal. The historical gold to silver ratio has traditionally sat around 15-1. Today, the ratio is completely disconnected from physical reality. Silver sits exactly at the convergence of an acute industrial supply shock and a worldwide fiat currency debasement crisis. You cannot print physical silver, and you cannot replace it in a high-density circuit board. It is being consumed and destroyed in microscopic amounts inside modern electronics, meaning much of the silver mined is never recycled. As gold marches inevitably toward $18,000, silver will inevitably snap back to its historical monetary ratio. If gold reaches $18,000 and the ratio normalizes to 40-1, you're looking at silver prices eclipsing $450. The institutional market has fundamentally misunderstood silver for decades, treating it merely as a volatile byproduct of base metal mining. The sheer volume of paper derivatives suppressing the spot price is beginning to shatter because you cannot satisfy industrial demand with a paper contract. This physical delivery dynamic is rapidly draining the registered inventories of the London Bullion Market Association and the COMEX. Dr. Leeb's analysis highlights that silver is the final coiled spring in the macroeconomic machine. It is the absolute ground floor of a structural, permanent paradigm shift in how human beings value irreplaceable natural resources. The structural reality that Dr. Stephen Leeb describes is no longer a bold future prediction. It is an undeniable macroeconomic event that is already in motion right now. The death of the petrodollar is permanently in our rearview mirror. New Era Gold's current ascension to nearly $5,000 is absolute mathematical proof of a deeply fractured fiat currency system, and its ultimate journey to $18,000 is simply a matter of financial physics clearing the global ledger. For it's under math of money. Meanwhile, silver remains the ultimate pressure valve, an irreplaceable elemental asset caught directly between immense industrial consumption and an aggressive awakening of monetary demand. The greatest transition of sovereign and generational wealth in human history is happening right now in real time. Curse Golden River. The only remaining question is whether you truly understand the mechanics of this monetary shift before the global markets fully price it in. Thank you for taking the time to watch this deep dive analysis today, and if you found this advanced breakdown valuable, please don't forget to like, share, and subscribe to the channel.